Intermountain Lumber was a tax court case analyzing whether a corporate formation was non-taxable under Section 351. I usually think of Section 351 as having three requirements: a transfer of property in exchange for stock and control. Intermountain Lumber dealt with the control requirement. In order to qualify under Section 351, the person or persons transferring the property must receive, in exchange for such property, stock in the transferee corporation that constitutes control. If there is only one class of shares, control simply means 80% of those shares. In general, ownership, for purposes of the control requirement, is determined by examining the obligations and freedom of action of the taxpayer with respect to the stock received in the exchange. The control requirement is generally not satisfied where, at the time of the exchange, the taxpayer is under an obligation to transfer the stock of the corporation acquired in the exchange to another person. In Intermountain Lumber, Shook owned a sawmill, and Wilson had logs to be processed. Shook agreed in advance to form a corporation and to sell 50% of the shares of the corporation to Wilson. Shook formed the corporation, transferring the sawmill to the corporation in exchange for 100% of its shares. Shook then, as previously agreed, sold 50% of the shares to Wilson. After the sale, Shook owned 50% of the corporation, and Wilson owned 50% of the corporation. However, only Shook had contributed assets into the corporation. Wilson did not transfer any assets into the corporation. Therefore, Shook was the only transferor to be considered in determining control. The court held that because Shook was under an obligation to dispose of 50% of the shares of the corporation, he did not own the required control percentage of 80%, and therefore Section 351 did not apply.